Have you ever wondered what lessons a company's past, their challenges and triumphs, can really hold for us today? Imagine stepping back in time to a very specific snapshot, 1994. That was a year that, well, it certainly didn't roll out the red carpet for businesses.
Welcome, everyone. Yeah, we're doing a deep dive today into the Markel Group's 1994 shareholder letter. And this isn't just some dusty financial report. It's a remarkably candid window into how a company navigates a really challenging environment, how it doggedly maintains its core values and shrewdly sets the stage for future long-term success. It's kind of a master class in resilience.
Absolutely. Our mission today is to, well, thoroughly unpack this foundational document. We're going to try and extract the most important nuggets of knowledge, uncover some surprising insights about navigating a complex business landscape, and really understand the maybe strategic thinking at play. You'll gain a shortcut to being well-informed about Markel's distinct strategies and the broader business context of the mid-90s, especially how they applied principles that, frankly, still feel relevant today.
Right. And to truly appreciate Markel's performance, we first have to understand the battlefield, so to speak, of 1994. The letter itself immediately sets the scene. It tells us it was a year marked by a major earthquake and rising interest rates.
Yeah.
And these weren't just, background noise. They created significant headwinds, particularly for investment returns, which, as we'll see, played a big role in their reported financials.
So, okay, with those formidable external pressures, I mean, an actual earthquake, plus the less dramatic but maybe equally impactful rising interest rates, what were the direct financial consequences for Markel in 94? I'm curious to see how those macro pressures really translated into their numbers.
Well, the numbers, they tell a pretty clear story of those external challenges weighing heavily on, let's say, one side of the ledger.
Okay.
The letter reports net income for 1994 at $19 million, or 3.33 cents per common share,
Okay.
which is a noticeable step down from $24 million, or 4.25 per share back in 1993.
Yeah.
And stockholders' equity also saw a dip. It went from $151 million in 93 down to $139 million in 94. Now, this decline was primarily driven by something called unrealized losses on their bond portfolio,
Ah, okay.
which was, of course, due to those rising interest rates we mentioned.
Unrealized losses. Okay, for those of us who might not deal with financial statements every day, can you quickly unpack what that means in this context?
Sure, certainly. Think of it this way. When interest rates go up, the market value of existing bonds, those fixed income investments Markel held, typically goes down.
Right, because new bonds pay more.
Exactly. New bonds are issued at higher rates, making the old ones less attractive by comparison. So an unrealized loss means the value of those bonds on their books decreased on paper. But crucially, Markel hadn't actually sold them yet.
Okay, got it.
So it hit their equity number, the book value, but it wasn't an actual cash loss unless they decided to sell those bonds at that lower market price.
Mhm.
It really highlights the inherent volatility of financial markets, doesn't it? And it's why the letter explicitly states that, quote, total return differs from reported results significantly by changes in the market value of our investments or unrealized gains and losses.
Yeah.
It really raises an important question for any investor, I think.
Hmm.
How do you balance those short-term market fluctuations, which definitely impact these reported numbers, with a clear, unwavering long-term strategy?
It's a constant tension, isn't it, trying to navigate that? But here's where the Markel story really takes an impressive turn and I think offers a crucial insight. Because despite those external financial challenges, despite the dip in net income you just walked us through, the letter describes their underwriting performance as, quote, outstanding for 1994. That feels almost counterintuitive. What factors allowed them to shine so brightly in such a difficult environment?
Yeah, it really does seem counterintuitive at first glance. But this is, I think, a core takeaway from the letter. It speaks volumes about their discipline and their strategic focus. Markel achieved its third consecutive year of underwriting profitability, which is, frankly, no small feat in a year riddled with an earthquake and market turbulence like that.
Third year in a row. Wow.
Yeah, and their gross premium volume, it advanced a remarkable 12% over 1993, reaching $349 million. And earned premiums saw an even more significant gain, 26%, hitting $243 million, which, the letter notes, actually exceeded their own internal expectations for the year.
Mhm.
So this isn't just growth for growth's sake. It's profitable growth in a tough market.
That is seriously impressive, particularly for a year with those headwinds. The letter also points out an improvement in their expense ratio. It declined from 35% in 93 down to 33% in 94, and they explicitly say it was by holding the line on underwriting expenses, so cost control too.
Right, discipline on costs.
But you mentioned the Northridge earthquake that surely must have impacted their claims, right? The letter indicates their loss ratio did increase to 64% from 62% in 1993. So they weren't entirely immune to the year's catastrophes.
Oh, absolutely not, and that's a really important detail to include. The Northridge earthquake serves as a concrete example of those unpredictable, real-world risks inherent in the insurance business. It clearly impacted their loss ratio, pushed it up a couple of points. Yet, and this is the key part, even with that specific major event and the claims generated, Markel still maintained a strong underwriting profit margin of 3%. They reported a combined ratio of 97%.
97%. Okay, put that in context for us. How good is that, really?
Yeah, 97% might just sound like a number, but to really understand the significance, we need to compare it. Compared to the property and casualty industry average for 1994, that average was a significantly higher 107.7%.
Wow, 107.7 versus 97. That's a huge difference. What does that 107.7 for the industry really mean in practical terms?
It's a critical distinction. A combined ratio over 100% means you're losing money on the basic business of insurance. So, to put that 107.7 industry average into perspective, it essentially means that for every dollar in premiums, the average P&C insurer collected in 1994, they were paying out roughly $1.08 in claims and expenses.
Ouch. So the average insurer was losing money just writing policies.
Exactly. They were, quite simply, losing money on their core insurance business, hoping to make it up on investments, which was tough that year too. Markel, at 97%, wasn't just profitable on underwriting. They were doing so quite handily, turning a 3-cent profit on every premium dollar before even considering any investment income.
Okay.
This isn't just a number. It's really a testament to their underwriting discipline being the bedrock, the foundation for long-term stability and resilience. It kind of proves that a strong core business can absorb shocks from other areas, like those disappointing investment returns we talked about, and still come out ahead. It's about not letting external chaos compromise your fundamental operation.
That amusement park ride analogy the letter uses is quite clever, isn't it? It says, danger is part of the appeal of amusement rides. For every insurance company, risk is part of providing insurance coverage. It's a nice little reminder that insurance, at its heart, is a calculated gamble. So beyond their general underwriting discipline, how did Markel specifically engineer their ride, let's say, to be thrilling but safe in 1994? What were the particular, maybe less obvious risks they really focused on managing?
Yeah, I like that analogy too. It fits. And this gets into a crucial aspect of their strategic focus, showing a deep understanding of their whole risk universe. Markel devoted, quote, special attention to identifying and mitigating particular risks, especially those risks with long, unpredictable tails, the ones that can come back to bite you years later.
Like what, specifically?
Well, one of their most significant accomplishments highlighted in the letter was the reduction of exposure to claims like environmental impairment liability, often just called EIL.
Okay, pollution stuff.
Right, essentially covers long-term pollution damage.
Yeah.
Very tricky. They also targeted pollution and pollution-related bodily injury, sometimes called toxic torts, claims stemming from harm due to exposure to hazardous substances. These aren't your typical fender-bender claims. These are complex, often very costly liabilities that can linger for years, even decades, after whatever incident occurred. That makes them notoriously difficult to reserve for accurately.
And they made real quantifiable progress here, didn't they? The letter gives numbers. They reduced EIL exposures from, 109 active sites in 1993? Down to just 11 in 1994. That's huge.
A massive reduction, yeah. Open toxic tort claims also declined significantly, from 417 down to 307.
Wow, that sounds like an extremely focused, almost like surgical effort to clean up the books and reduce future uncertainty.
It absolutely was.
Yeah.
You get this sense of real determination there.
Yeah.
While they adopted a kind of wait-and-see attitude to some complex legal questions swirling around these issues, they simultaneously took very decisive, very proactive action to limit their exposure to these specific types of claims, getting them off the books. They also continued efforts with their reinsurers like Shan Evanston to, quote, commute or prepay their liabilities. Now, think of commuting like settling a complex long-term debt up front, maybe at a discount, just to remove that uncertainty and future financial obligation from their balance sheet. Clean slate.
Okay. Paying now to avoid bigger headaches later.
Precisely. It allowed them to significantly reduce future exposure and really clean up their balance sheet. And the numbers back this up. The balance for unpaid losses due from reinsurers' money they were counting on getting back actually declined quite significantly.
Yeah.
From $261 million at year-end 93 down to $181 million at year-end 94.
So they were relying less on collecting from reinsurers later.
Exactly. It demonstrates a really proactive approach to managing their reserves and their external liabilities. This isn't just, good accounting. It's about building long-term confidence in the stability of their financial position, reducing dependencies.
So, okay, on one hand, we've got this really outstanding, profitable underwriting, incredible discipline in managing these complex risks. But on the other hand, we know they faced those challenging investment returns. How did Markel view their overall investment strategy in this seemingly contradictory context? How did they reconcile these two very different performances in their communication?
Yeah, it's a great question because it really highlights their unwavering commitment to a long-term total return concept, a philosophy that looks beyond just current income. While net investment income did decline from $32 million back in 1990 down to $29 million in 1994, their strategy explicitly emphasized the overall long-term investment return. That encompasses both income and capital appreciation, the growth in value.
Right, total return.
Total return. And the letter candidly acknowledges that, quote, realized investment gains are unpredictable from one year to the next. And they add, it's doubly true for unrealized gains and losses. This really speaks to accepting short-term volatility as just part of the game rather than panicking or changing course every time the market hiccups.
And the actual total investment returns for 1994 then, given this philosophy, they were 7.9% for the total portfolio. Equities did okay at 7.8%, but fixed maturities, those bonds you mentioned, were slightly negative, minus 0.2%.
Right, dragged down by rising rates.
Yeah. The letter admits these returns did not meet our expectations. They're honest about it, but it also quickly pivots to emphasize that taxable equivalent total returns over the last 5 years continue to be strong. So what does this all really mean for you, the listener, trying to understand their investment philosophy? What's the real takeaway here?
I think the profound insight here is Markel's unwavering commitment to patience. Patience as a strategic asset. Even with those disappointing short-term investment returns. I mean, that negative 0.2% on fixed income, which few companies would exactly trumpet.
Are you kidding?
They didn't flinch. They didn't suddenly overhaul their strategy. Their portfolio, which they described as being made up of high-quality investments, wasn't chosen for quick wins. It wasn't built to beat quarterly benchmarks. It was built to endure, to compound value over the long haul. So the real takeaway for you, I think, whether you're managing a business or maybe just your personal finances, is that in a world that often seems obsessed with quarterly numbers, Markel demonstrates that true, enduring value is often built by embracing long-term volatility, not by trying to constantly outrun it or time the market perfectly. It's a stark contrast to the, reactive short-term mentality we see so often. And arguably, it's a crucial blueprint for resilience. They understood that sometimes doing nothing, simply holding your quality assets through the storm, is the most powerful move you can make.
That's a powerful lesson in conviction, isn't it? Especially when those headline numbers don't look great in the short term. It certainly sounds like 1994 was a year that required exceptionally steady leadership, not just in setting the strategy, but also in communicating it effectively. How did Markel's management really strike that balance? Was there any risk that their transparent confidence could be misconstrued when facing mixed results? Or did they provide enough detail to truly differentiate their approach and justify that confidence?
That's an excellent point.
Yeah.
Because communication is key in a year like that.
Yeah.
The letter maintains a tone of, transparent confidence, which is quite striking given the investment challenges. They're very open about the difficult investment returns and the impact on reported net income. No sugarcoating.
Right.
However, they skillfully balance this by highlighting the gratifying growth in the core business and framing it within the strategic evolution of Markel. They reminded shareholders of the journey from what was once a small family-owned brokerage firm to a publicly held underwriting operation. This narrative of disciplined expansion and maturity was crucial, I think. It wasn't just confidence for confidence's sake. It was contextualized confidence. They explained why they felt good about the long term, despite some challenging numbers in the present.
They also make a point of mentioning the retirement of Stanley B. Markel. After more than 50 years of service, including 29 years as president and vice chairman, it's clear they acknowledged his significant contribution to the company's success. How does a moment like that, a foundational leader retiring, fit into this narrative of both looking back at their roots and looking forward with confidence?
Yeah, that mention is quite telling. It serves as a powerful symbol, doesn't it? On one hand, it highlights a deep respect for the foundational figures and their immense contributions. It anchors the company to its history and its core values. But it's also simultaneously a clear signal of continuity. It's a forward-looking perspective, suggesting the ongoing evolution of the company. It demonstrates that the principles instilled by leaders like Stanley B. Markel are embedded in the culture, not just tied to one individual.
Right, the philosophy lives on.
Exactly. And then the letter immediately pivots to emphasize the underlying earnings power of the business, which, they state, is best reflected in their core underwriting and investment operations. And these operations, they point out, have shown an impressive 18% average growth rate since 1990. This demonstrates a really clear focus on sustainable, fundamental profitability. Rather than, fleeting market gains or clever accounting maneuvers, it reinforces that whole idea that knowledge, that discipline, is most valuable when it's understood and applied for the long haul, focusing on what truly drives consistent value over decades, not just quarters.
So wrapping this up, what we've gleaned from Markel's 1994 letter is, well, it's a truly powerful lesson in resilience and discipline management. They navigated a year of really significant external challenges, a major earthquake, rising interest rates, volatile markets, by doubling down on their underwriting excellence, by proactively managing those complex risk exposures we talked about, and by maintaining a steadfast, almost unwavering long-term investment philosophy. You've really seen how they balance that short-term performance, which wasn't always pretty, with enduring principles, not shying away from the bad news, but carefully contextualizing it within a broader strategic vision.
Absolutely. And hopefully you, the listener, now have some deeper insights into how a company can not only survive, but actually strengthen its core in adverse conditions. Think about how these principles, that focused, profitable underwriting, that rigorous risk management, especially of those tricky long-tail liabilities, and that incredibly patient capital allocation could apply to your own decisions. Whether that's in managing a business, making personal financial choices, or maybe just navigating unpredictable challenges in life, it really comes down to understanding what you can control, sticking to your core strengths, and having the conviction to let your long-term strategy play out, even when the immediate environment feels turbulent or chaotic.
Yeah, that conviction piece is key. This deep dive into 1994 Markel, it really isn't just history, is it? It feels more like a blueprint for enduring success, a real case study in strategic patience. And it makes you wonder, in today's incredibly fast-paced, often intensely short-term focused world, how many companies are truly embracing this kind of disciplined, long-term thinking that Markel exemplified back then? And maybe more importantly, what are the ultimate consequences for those who don't prioritize that same steadfast conviction over the long haul? Something to think about.